Okay, good afternoon, everybody. Welcome to the weekly take on the market. Today is Friday, June 10th. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Take a moment to read the disclaimer. I'm not licensed. Nobody at IBD is licensed. We don't make buy, sell, hold recommendations. Research and education is our sweet spot. Let's take a moment to look at this. All right, so we'll talk about the markets. I think I'm going to skip the industry groups, or maybe I can squeeze it in really quick. Nothing's changed there. It's the same groups that are holding up. Energy and even energy is, I don't know, it seems a little tired. It's come a long way. But it's relative to everything else, it's the best area. So not a whole lot's changed there. Talk about some stocks and then the quote of the week. So the markets, there's a lot going on in the markets. I thought I would pull up this chart of this stock breaking out, and gosh, what a breakout, right? This has just been so clean. Makes a new high at 17, runs to 20, tests the 50-day from 20 to 31, almost a straight line, tests the 50-day again, breaking out of this pattern, looks very bullish. And I've hit the ticker because I'm just curious what you guys think about this pattern and this action. Like if this was something that you would, I'd love to be in for sure. And wish you had, captured, because it's been a pretty good ride. And this is, well, it's a chart of interest rates. It's the inverse of the bond market. Let me pull it up in MarketSmith. And 0 TNX. And that's the 10-year note. And so that's the yield. The 3.167 was the high. So this is the problem with the stock market, is yields are going higher, and the velocity of them, the delta of the yields going higher, is pretty significant. And it's just been a huge headwind for the market. You can see the weekly chart, and I've talked about this a few times. I don't know how I would play that. I guess you could go short the bond market in the futures, but there's probably some ETFs that track that. But I just kind of missed this trade mostly. But you can see that it's off the charts. It's so far down. I have to go to the monthly to be able to see. But 4 to 30. Now I know it was just from an extreme low. Down there, that's the COVID low, but it's the move is significant, and it's just kind of back to normal. So interest rates at 3.5% on a 10-year it shouldn't cause this much damage to stocks necessarily. I mean, I think I talked about it one time when I was in the business. I got in the business in 1995. I remember there was some issues with the bond market in late 94, which caused a little bear market. This one right here. I think I was in the business then, but didn't have any money. I wasn't trading, so I was just getting started. But look at, there's, the bond market. But, most of my career, a lot of it with the bonds were, the 10-year was 3 to 5%. So it's not the number, it's the delta, the change, the way that it's gotten here is causing issues. So there's, I think, 0FVX, which is the 5-year note, looks very similar to the 10. They should roughly be the same. And then the 30-year, which, I'll just go with TLT. See, it's been down 1, 2, 3, 4, 5, 6, 7 months in a row. I think it's off, probably 25%. Well, that's off the 52-week high. I don't know if that's including that. Probably not. So it's probably, 30% off the high at least. So that's where most, if not all of the issues are in the market. And today, inflation number came out, and honestly, I don't even know what the print was. I don't know what the nominal number was, partly because it doesn't really matter. The reaction to the news is what I'm most interested in. I assume it was as high as they expected, if not higher. So, we're all kind of feeling it. We all know. And so when interest rates start rising and inflation's an issue, these types of companies come under pressure. So here's total market cap of companies with price to sales greater than tenfold. And you can see in the bubble, there. Now, this isn't inflation adjusted, so it's probably not as extreme as it looks, but it's extreme. And so those companies, the Shopifys of the world, that have a great narrative, they were all great stocks and we loved them on the way up, are coming under a lot of pressure, tremendous pressure, obviously, on the way down. Energy has been the best place to be. If you've been in energy, even only a little bit, and you've avoided the high, the high price to sales companies, you could be positive for the year. That shouldn't be an issue. So there's ways to navigate this market, whether it's just avoid those stocks and or be positioned in the right area. It's made a big move off the low from, it's as far as a percentage of the S&P 500. This is a great chart, 22V research. And, in the 80s or September 90, it peaked at 14.8%. January 99, it bottomed at 5%. Not a surprise, right? Who wanted to own energy in January of 99? And you were right for 12 months to want to avoid energy, because 99 was just, from an index standpoint, just an incredible year, especially in the NASDAQ. But then it rallied and, tripled as far as a percentage and peaked in June 2008. And then the financial crisis, where everything got hit, didn't matter what you were in, they were all going down. And now it's bottomed in October 2020 at 2%. And if we're in something like this type of scenario, it should get above this kind of average relative market cap, which means relative to all these other stocks, maybe you've got another double. Now, it won't happen overnight. It could take time, but there could be a really secular big theme here with these types of stocks. Just keep that in mind. You have the imagination that they could go a long way. I think I prefer they all set up in bases. I own very little. I own a couple of drillers. I own one equipment oil manufacturer, and I own a driller. But a few days ago, I tweeted that oil was pushing to highs and lots of good news as far as, well, bad news, I guess. Good news meaning oil prices going higher, and the oil stocks felt very tired. They felt sloshy. So I just pretty immediately liquidated most of them. I bought one driller today that's coming back in, building type of a handle. So this is the area to be in until otherwise noted. I just don't see any reason to try to pick the bottom on the Shopifys of the world. Not to pick on Shopify, but that's just kind of one of many of former leaders that have topped, and based on history, some of them will come back and some of them won't. In fact, I'll pull up a couple of examples, kind of give you an idea on what history portends for some of these newer great leading stocks based on, we'll go back to the 99 top. Margin debt, you can see margin debt is kind of interesting. You probably don't want too much margin debt, but we need some of it. We need that animal spirits. We need that extra juice to push the markets. And it's really actually rather there be some out there as far as you know, potential for higher prices, as crazy as it sounds. You can see margin debt from 2019, 2020, 2021, and it just kept increasing as the market was going higher. And the stock market is a crazy animal that most people who haven't been in this business or studied it at least a little bit, it's hard for them to understand that higher prices portend to higher prices, and lower prices portend to lower prices. Let me say that better. It's the one place where each higher price generates more demand in general, until there's a tipping point. It's kind of like building a sandcastle. But almost always, every higher price actually increases the chance for more demand, more at that price. And it works the opposite way. Think about it when you're not in something you want to buy, and how anxious you get every time it makes a new high, makes a higher price. Or if you own it, how much you love it every time it makes a higher price. And the opposite way, every time it makes a lower low, there's less demand for it. Stocks are going down just don't interest me. In most people, even though institutions aren't buying on the way up, they really are looking for the quality merchandise. And so they, if it's not going up at some point, they probably will stop their buying and say, wait a second, something's not happening here. So margin debt is collapsing, which is a problem, right? It's creating supply. You can find the margin debt on FINRA's website, which is really cool. I didn't know this, but you can just track it. It's probably where IBD gets it, but I like FINRA's website has, you can go back a number of years, so you can see the trend. And so here's the trend, 829 in January, 835 in February increased, and then a decrease in March and a decrease in April. So margin debt is decreasing. I think I'm going to skip the industry groups. Oh, you know what? I haven't even gone to the indexes. Yeah, so I'm going to skip the industry groups. So bear with me. Let's pull up the indexes. So here's the NASDAQ. Doesn't look good at all. Let's refresh it and see. The price action is probably pretty up to date. We've been closed for 25 minutes. The volume won't be up to date because the volume is delayed. But you got, yesterday was, a sign that something was wrong. So hopefully, if you tried some stuff, you probably were doing some liquidating yesterday. I was doing a lot of liquidating of anything that I had, although I don't have anything that's NASDAQ related. Like I said, I was selling a lot of my energy related stuff, and then actually getting short the NASDAQ. So I really believe that we're going to take out those lows. That's the way I'm going to play it. But honestly, I think that's good. As crazy as it sounds, it'll make me bullish if we can take out those lows, because it's really going to shake the tree if that happened. Everybody's looking for a tradable rally or a bear market rally. And so I just felt like it was it couldn't be that. It couldn't be a tradable / bear market rally. So then what are the two options? It's a major low, and we're in a new bull market, or it's going to roll over and make new lows. And I put the probabilities of those at, say, a major low, 10%, 15%. Doesn't mean I'm right, but that's my analysis. It just didn't feel like a major bear market low. The S&P is only corrected 10, 12%. It's amazing how well the S&P has actually held up. So if it wasn't that, then I put the odds at 85, 90% that it's going to roll over and make new lows. So that's how I'm playing it. But I'm not being super aggressive. I don't have a pedal to the metal type short position. I just don't need it. If I can add a little bit here and there from being short, great. The big money is made really in the long side and protecting what you have, because eventually we'll make a low, and hopefully I'll have some bullets left and some mental capital to participate. So I just think we're going there. That doesn't mean it's going there Monday, but I just think eventually it's got to undercut that low. It would be quote unquote healthy, the old healthy correction. I've never been long a healthy correction. Believe me, I don't want to be long any healthy corrections. Who's that healthy for? It's healthy for the people on the sidelines. And so here's the S&P. Looks very similar. I think probably this is the magnet. In a perfect world, what would happen is the S&P would come down, say 3,800, start to rally, but the NASDAQ would boom, go do that, like really undercut and then go back up. That would be ideal. That would be the best case scenario, because then you'd have another positive divergence that, one index making a new low and the other one isn't. The other thing is, because interest rates are so, important to this market. Let's see, did the TLT make a new low today? I don't know, but let's go to, the short-term rates, 0FA. So this is obviously making a new high. When was that high? On May 5, 3084, May 6. So that's making a very clear new high. And the NASDAQ, May 5, May 6, down here, I'm guessing somewhere in here, right? So it's not making a new low while interest rates are. I mean, I'm just grasping for anything to keep me on my toes and be flexible to the change, but that's probably the only positive I could see as far as the NASDAQ and the S&P. Like I said, the S&P is what? Here, let's use the comparison chart. I don't use this that often. I should use this more often. So here's the S&P. Let's add in the NASDAQ. And one thing very interesting today, it was gold. Gold got a bid today. It had a really strong day. Now, I don't know what to make of gold. It's like the strangest thing. It's just, right when you think it's gonna pay you, it doesn't. So I'm not the biggest fan of gold, but I do watch it. You can see year to date, if I got this right, S&P's down 18 now, NASDAQ's down 28, and gold is actually up. So, it's done its job, so to speak. It's held. You didn't lose if you had any in gold. I don't know. I mean, it's the thing I think about is the money is flying out and it's either evaporating into thin air or it's going somewhere. So where is the money going, right? If bonds are coming down, it's due to what? People are selling bonds, and stocks are going down. People are selling stocks. And where's that money going? I don't think it can go into the gold market, obviously. I don't think it's going into crypto either. Crypto's on fire. Where is all that money going? Real estate looks, really, really like it's slowed down. Mortgage rates have gone from, 2 to 5 and change. So I don't know, is it evaporating in thin air or it's going somewhere? So I'm always on the hunt for trying to figure out where the money's going, because if there's a chance that I can, participate and go along for the ride. So there's the S&P on a weekly. This line is like, your line of demarcation. That's the 150 week moving average. And I think I've talked about this before, but again, it's held, broke bad on COVID, but look how quickly it came back. Like it just didn't like staying below that. If I were to go back to 2009, you can see how before the crisis, this is 07, this is 08. Here's that line, just spending way too much time in there. And now then it's living below that line 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12 weeks before boom, 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 breaks wide open. So we start living below that line. That's kind of it's probably a bad omen. So and then the NASDAQ, I think, has lost that line a little bit. Yeah. So the NASDAQ, maybe if it starts to live below that line, then I think we're probably headed for a whole nother type of leg lower, something like that. Anything else in the indexes? No, I think that's good. Okay, so industry groups, we're going to pass on that. You know the drill. Hopefully you know where to find them. Stocks to watch, and a couple people have asked about, stocks. Can you evaluate this? What do you think of that? And I can't, obviously, from a compliance standpoint. Then it's okay. Well, what do you look for in an idea? And there's a lot that I look for. There's no one single thing that I say, oh, this is what I look for. But I look at a lot of data points. I put more weight on certain data points, like quarterly earnings and institutional sponsorship and relative strength is a big weighting. I don't have a checklist that says, relative strength's a 22% weighting and earnings last quarter's an 8% weighting. It's just all kind of mental, kind of when I evaluate something. It's like art. I don't know anything about art, but I know they're probably, and wine. I know nothing about wine. I couldn't tell you if is a $5 bottle or a $500 bottle, but I know that out there are people that can. And they just know, they know what a good bottle of wine or a good glass of wine should taste like. So I just know, based on looking at thousands and thousands of stocks and model books and just stocks, I just kind of know what a good stock should look like. So I don't have a perfect answer for you, but Saturday, hopefully you can make the event. I'll kind of go through that. Like we'll evaluate some stuff in real time as it's not this coming Saturday, tomorrow, it's the following Saturday, but as I look at stocks. So let's pull up. So some energy stocks. So is it Weatherford, WFRD? Tried to break out yesterday, pulled back today. This could really, in essence, still be a handle. So, with a new buy point right there, I think that's okay. If now, not great earnings and sales, and it's in the right group though. Look at the relative strength, how strong that is. Right? So that one looks interesting to me. And if oil stays higher, if they're going to drill for it, they're going to need these guys to provide all the products. Neighbor is building a cup, and I think after today, this will be a handle. I'm fairly certain it's going to see that as a handle. But today's action was pretty encouraging. This is the one I bought today because I liked it. It was down bad, and then it started to come back, even though the market didn't. So that looks like a cup with handle. So I have my first position there, and if it starts to go up, I'll add to it somewhere in there. And a lot of it depends on the group. This is going to be highly tied, obviously, to the oil and gas group. So I was very interested in some stocks like DLO. This was a stock that I did really well with over there. So, I was interested in buying here. I think I might have even bought it here, tried it there. I did buy it there, but sold it just because of the market for, just a small gain. I bought it after it gapped up on the earnings. But then I went back and studied, like, what can I expect from something like this that's so beat up, right? So the weekly chart, this is just trash. It's not a good weekly chart, I have to admit. Snow, this is one of those companies in that price to sales metrics, and look, it's just starting to, it's just hurting the company so bad. And GitLab announced, I don't know if they announced earnings. Yeah, they did. And the revenue was, the street loved the revenue, but look, it can't hold the gains. Just having a hard time holding those gains. So if I go back to the 2000 top, let's go to Cognizant, and you have to try to remember which companies still exist so you can see it in the database. So I had to do a little bit of researching, but Cognizant was a really strong stock look at this. This is a monthly chart, right? So it breaks out. It's just a really good stock, and held on all the way to 2002, right? It did everything it could to hold on. and ultimately made a new high in June 30th of 2003. But if you go back and look at the correction that it underwent, I gotta go back a little bit further. I wrote down, I know I wrote down, oh yeah. This you can hardly even see is 75% move down, minus 75%. So it breaks out of this IPO base and corrects 75% in a very short amount of time. Very similar to what's happened to some of the stocks now that we've encountered. But the company was fine. They were doing great. They just got caught in a windstorm, a hailstorm of, tech sold off, and it took them a while. But eventually, it started to work. And if you look at where this stock is now, just huge winner. So the moral of the story is, if you like Cognizant, the business, the company, that they're there, you still want to cut your loss. I think just don't give up on it. Wait for it to consolidate and make a new high, right? So you can split adjusted, you paid 330. The low, I think, was 75 cents or something. So, but 330 was cheap, incredibly cheap. And 5 was cheap. And 12 or 14 was cheap. So wait and allow the companies to show themselves. We have all these new names, this new merchandise, and I don't know if DLO or GitLab or Snow is going to be one of the great winners. I don't need to pick that. I'm just going to let it do what Cognizant does. Now, some of them won't, and Juniper is one that I was trading here. It was incredible stock. It just seemed like the stock was up every day. It was one of those stocks that, if the market closed strong, you could go buy Juniper and you could sell it in the morning, the next morning, 5 points higher. And I'm not kidding. It was like giving money away back then. It was just crazy times. And so if you, let's see, if you see broke out, ran up, and just every day it's like, here, you buy it, next day you could sell it if you wanted. You buy it, you could sell it higher the next day. You buy it, you could sell it higher the next day. You buy it, you could sell it higher the next day. Eventually didn't work, right? This one cost you, but all the way it was just such a great type of trading stock, like if you were looking for exposure. But that's not the strategy. That's neither here nor there. What I'm saying is, Juniper was a super strong company in fiber optics. I don't know fiber optics that well. Assume it's all around us. Still an amazing business. Juniper was, allegedly this new comer in that area. And if you bought the stock, it's done nothing. It's done nothing for 20 years. When I say nothing, I mean in general, right? You could have bought it at 12 and sold it at 20, but why bother? You could have bought the S&P in this time frame and went fishing or golfing and quadrupled your money. What do you need Juniper for? So if you loved CTSH and you loved Juniper at those times, you have to sell them, and then you just wait and you allow which ones to shine. And if you waited for Juniper to make a high and never really did, maybe you bought it here, maybe you bought it here, it never really got going, but you just allow it, wait for it to make a new high, like CTSHs. So the moral of the story for me, for these guys, these monthly charts, DLO, Snow, and there's a ton of them out there that I traded during the 2020-21 melt up. Some of them are not going to come back. They're going to become the Junipers, and some of them are going to become the CTSHs. And I don't know which is which is why I just sold them all, because I was like, I don't need it. I'm going to let them show me which one is going to be the one. So I'll pay 200 or 250 for Snow 2 years from now. Or I'll pay 100 for GitLab 3 years from now. Whatever it takes, I don't know. But let them build bases. You're just much better off. Is the moral of the story for that. Okay, let's go to the quote of the week. And I had a few candidates, but I wanted to bring up Charles Harris because he just recently posted the presentation he did at an IBD CanSlim Masters program. I can't remember the year he did it. I was in the audience. It was before COVID for sure. So it was probably like 2018. I highly recommend you watch it. It's called A Trader's Journey. If you search that on YouTube, Charles Harris, where he talks about his track record and he goes over some trades, and a lot of it is on psychology. I don't want to give away the ending, but he's what he would term, and I'm kind of in that like a boom and bust trader. So I've had some periods where the money's just falling from the sky, and it's incredible. I just can't believe how much money I'm making. And then I've had periods where it's like, I don't think I'll ever make another dollar in the stock market. Like, that's it. It's just over. I cannot make a dollar in the stock market. And it just goes in cycles. It's the way the market works. This quote is one of my favorite quotes from Charles because it resonates with me, because it says, I'm both proud and embarrassed by my long-term track record, because he's had some amazing years, and he's had some years where he'd have been better off working at McDonald's, and I know that for a fact, because I've had years where you're trying to make your living from the market, and I did that for a long time, and I respect anybody who can make their living from the stock market, because it's not easy. You have to overcome the market, and then you have to live. If you have living expenses, you got to take money out of your account. You take money out of your account to pay taxes, and then you have to, it's like a business, and you can have a year where you lose. So then what? You might not have to pay taxes, but you have to drain some of your capital to live, for living expenses. So it's a tough road, and Charles has done it for a long time. So I really like Charles a lot. I think he's one of the most transparent traders I've known in this day and age, where everyone is I don't know if everyone is the right word, but it's hard for people to be honest about how hard trading can be sometimes because they have ulterior motives to say otherwise, right? So it's difficult. But it's rewarding both financially and psychologically when you're in sync with the market and you're getting things right. It feels great, right? It's just so much fun. And when you're the other way, it's not so much fun. But you just have to know it's going to come and go. And when you're riding high, be prepared for the other way. And when you're down in the dumps, know that it will change. It will change for you. And that's what Charles talks a lot about in this in the video. All right. Last but not least, we will do the training session on Saturday, June 18th. You should see a pop-up on Marcus Smith's website, hopefully tomorrow, Saturday, and be able to register for that. And also, you'll probably get an email if you're a subscriber about it. Hopefully, you can make it live. I hemmed and hawed about the time. Because I know we have a lot of international clients, and so I would like to give them a chance. I talked to a lot of people all over the world. It's really neat. UK and Spain and Hong Kong and Japan and the Nordic countries. And so I wish there was a time that was like perfect for everybody, but unfortunately the world's too big. So I just picked 10 a.m. Pacific time and 1 o'clock Eastern. It'll be live, not recorded. This is a kind of an experiment. If it goes well, if the demand is good, if people like it, they say they would join again, then we'll do it again, and maybe I'll pick a different time to accommodate other people that might be able to join. So if you can make it, great. All right, so here's our contact information: marcussmith@investors.com, 800-831-2525. I don't even know how long this video was, but it probably was long. and I just can't seem to shorten it because the market is just so dynamic. There's so much going on. And it's funny. Every time I do a video, I think that's it. Next week, I will have nothing to say. But the market changes. It gives me a bunch of tidbits, and we're off and running. So have a great weekend, everybody. We will see you next week. Bye-bye.